morning, you're watching Businessworld Live. I'm Dani Laurel.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day Friday. Trade deficit swells to a 3-year high in 2021 with exports missing the goal and imports surpassing the target set by the government.
Economists warn that the war in the Ukraine may drive food prices even higher in the Philippines and other Asian countries.
Finance Chief Sonny Dominguez orders the Fiscal Incentives Review Board to look into the possibility of imposing the same amount of licensing fees on POGOs, regardless of their location.
And it's earnings season. Once again, two of the country's biggest banks report strong performances for the first quarter. We begin our broadcast with the country's trade deficit widening to a 3-year high in 2021.
That's as last year's imports exceeded the target while exports missed the goal set by government. Final results of the PSA's international trade data show that imports surged by a record 31.3%, surpassing the 30% full-year target by the Development Budget Coordination Committee or DBCC. On the other hand, exports grew by 14.5%, lower than the DBC goal of 16%. The trade gap stood at more than $43.2 billion, the widest since the $43.5 billion deficit recorded back in 2018. The last time the Philippines became a net exporter was in the years 1999 and 2000 when it logged trade surpluses. Oxford Economics expects the Philippines to be the second worst hit among emerging markets in terms of commodity shock from the war between Russia and Ukraine. The Philippines ranked second out of 21 emerging markets in Oxford Economics' latest research brief. Thailand is considered the worst hit. The research firm says commodity shock is composed of two factors, import prices and impact on trade balance. Meanwhile, MUFG Global Markets Research says the Russia-Ukraine war may also drive food prices higher in Asian countries, including the Philippines. MUFG said the war in Ukraine might add 2.5 to 3.5 percentage points to the level of Asia's food inflation. Food prices in the Philippines are seen to rise by 8.2% from July 2020 to January this year.
And speaking of higher food prices, manufacturers are now requesting an increase in prices of some products. That's as the costs of raw materials and fuel remain elevated. Shaila Francisco with this report.
Mrs. Abido decided not to get a cart for her grocery shopping to make sure that she won't go beyond her 2,000 peso budget.
Binibili lang namin, talagang importante lang talaga na kailangan lang naman talaga sa bahay. Katulad ng mga gatas nila, yung mga noodles, sabon, mga shampoo.
But she may need to further tighten her budget, as some manufacturers have requested a price hike due to high cost of raw materials, packaging and fuel products. Those items include salt, coffee, noodles and canned goods. But the Trade Department says they still plan to negotiate with manufacturers on their request.
Habang hindi po kami nagpa-publish ng panibagong SRP, hindi po gagalaw ang presyo. Hindi sabay-sabay mag-a-adjust ng presyo. So consumers will still have the choice.
However, supermarket owners say some manufacturers have already advised them of price increase for all categories.
What is a bit disturbing is that different rounds of increases, price increases for different products and different categories now every month. So, kumbaga, may mga abiso.
During its inspection, the DTI also saw that prices of some items, such as shampoo and soap, have gone up by as much as 2 pesos. But the department assures the public that they are coordinating with manufacturers to limit price increases to absolute minimum. Shaila Francisco, VR1 News.
A growth of no less than 6% all throughout the term of the next president. That's what Finance Chief Sonny Dominguez says is going to get the Philippines to grow out of its debt. How likely is that to happen? Let's get insights from Nicolas Mapa, ING Bank Manila's senior economist. Good morning, Nikki. Thank you for joining us. All right, Nikki, how big of a challenge
Good morning, and thanks for having me.
All right, thank you for joining us. How big of a challenge is that going to be? 6% in the next 5 to 6 years. How likely is that to happen?
Well, I'm one of the, I guess, less optimistic analysts in the market right now. If you remember the 6% formula, it really was delivered by a multi-sectoral growth strategy. We had strong growth from household consumption, capital formation, as well as government spending back in 2000, I think it was 13 all the way to 2019. Going forward after the pandemic, it does look like it's only going to be household consumption that will be sort of driving our growth momentum in the next few years. Very, I guess, pre-2014 growth strategy. Capital formation in the coming months might be constrained by the rise in global interest rates. I mean, it's not just here in the Philippines, but interest rates around the world are really shooting for the roof right now, given the outlook on inflation. And secondly, you have government expenditures, which was a hallmark of the past two administrations, likely constrained by the fact that the incoming administration, whoever will be taking over as president, will be faced with one of the highest debt to GDP ratios inherited by the previous administration. So the new president, he or she, will have to, tighten their belts just a little bit, just to ensure that fiscal sustainability can be achieved.
Okay, now speaking of that, are you worried that this above 60% debt to GDP ratio might further increase as we seek to recover and reopen? And will this, risk our credit rating?
Yeah, I guess the longer we stay at this threshold above 60%, that always leaves us, I guess, susceptible to a ratings action from at least Fitch. The other two big players, S&P and Moody's, haven't really sounded alarm bells just yet, but Fitch does appear to be very concerned about that relatively high debt to GDP ratio. So I think the new administration will really have to find, or at least pick and choose, the right, projects that would deliver revenue generation in the near term, while of course ensuring that so money should be well spent in the near term with the new president coming in, with the debt issue in mind. Also coming to mind that they need to make sure that the economy grows faster than 6%, and from the way that I see it right now, it's not likely.
Okay, given that, Nikki, at what level do you see us growing, at least for this year? And when do you see us at least hitting the mark? It's like in reference, of course, to what Dominguez said about what's needed in order for us to grow out of the pandemic.
How long?
Or of the debt, rather.
Well, I guess it just depends on what we do in the next year or so, what the new president will be laying out as his or her agenda. The ability to galvanize, a national effort, or to bring in or to bolster investor sentiment will be key when he or she steps into power by mid-year.
Okay, let's talk about the risks on the table here. You pointed out consumption in the Philippines will be hit, and you do have, the war in the Ukraine. You've got China also slowing down. We've taken a hit from tourism, just from the Chinese tourists, POGOs exiting, and COVID variants imminent. Tell us, to what extent are you worried about these things? Have we, hit the worst, for instance, of all these external crises, for the year at least?
Yeah, for here, it does look like quite a lot on our plate. Just the fact that inflation will be elevated this year, and given the fact that we rely 70% on household consumption for our growth. So higher inflation doesn't usually bode well for household spending. At the same time, you have, of course, the global slowdown. IMF and World Bank both trimming or slashing their growth forecast for this year. Which I guess is just, the silver lining here is that the Philippines is one of the few countries that actually had its growth outlook upgraded by the IMF at the recent WEO. So I guess that gives us some hope that, a domestically oriented economy can survive a landscape of global slowdown. But there are risks out there, as you noted. Inflation is still going to be high. Higher borrowing costs are going to mute or to cap some of that investment momentum that we are hoping to see this year. So I guess tall order for the next president, who he or she comes in. A lot of things to fix, and just to navigate this very challenging global environment.
But the policy divergence between the central bank and the U.S. Fed, how worrisome is that for you? And how much of a room does the BSP have left?
Well, I thought they ran out of room at the start of the year. You have the Fed last night, I think Chairman Powell coming out and saying that, we'll likely see a 50 at the next meeting, another 50 after that, and possibly a third meeting with a 50 basis point rate hike. So we're actually looking at a prospect of the BSP policy rate hike on the same level as the Fed. I've never seen that in my lifetime just yet. So I think the BSP, I guess, has been noble in its charge to try to keep support for the recovery. But in their own words, they think the recovery is on solid footing. So I think it's about time they start considering to tighten monetary policy to get ahead of the Fed and get ahead of the curve.
Okay, and now, Nikki, you did mention that we were the only country, or at least one of the few, which IMF raised the at least the growth forecast for. Why is that? And does that mean that, the risks are there for all the other countries, and surprisingly, we should be less hit? Why the divergence?
Well, I guess it's just the fact that we rely less on global trade. The main reason why they slashed or trimmed global growth forecasts is the fact that trade was likely slow down with higher commodity prices, with the supply chain disruptions. Philippines relies less so on your trade numbers. And I think they also cited the fact that, our COVID response has improved in the past few months. So that's going to be key, keeping our numbers down, ensuring that our public healthcare sector is in a good, in good standing, so that we can, put possible surges, at bay or keep them at bay. So it's pandemic response that we've been doing quite well, I think, in the past few months, as well as the fact that we don't rely so much on trade relative to our neighbors.
Okay, and last question on the same issue, inflation. We do have people saying, we've had several economists saying that is transitory. It was linked also to the lockdowns, perhaps, the things. But we do see the prices of oil continuing to be above 100 a barrel. How long can we withstand this? And are you definitively seeing this above the target for this year?
Yeah, well, last year, 2021 inflation was cost push. And there was an argument to hike back then, but the BSP just sort of put it aside and said, we don't hike during cost push episodes. 2022 can be argued as a cost push episode. However, one thing that's quite different is the fact that inflation expectations have started to rise. And I think that's the bigger battle that the BSP has to face. When they have to keep a tamp down and corral inflation expectations, when you have consumers and firms expecting inflation is going to be here and here next year, that's when you start to get conditions that just generate even more inflation. So we're starting to see a lot more petitions for wage hikes, transport fare adjustments. And, as noted in the earlier report, producers are tacking on a little more because they're starting to feel the pinch. So we're going to see prices rise across the board, I feel. And even if it's cost push, I think the BSP has no choice but to corral inflation expectations with some form of rate hikes in the near term.
Okay, so uphill climb there and a lot to be inherited by the next administration. Hopefully those policies keep our debt to GDP ratio at bay and inflation at bay as well for the consumers' pockets. Thank you so much, Nikki Mapa, Senior Economist at ING.
Take care, stay safe.
Meanwhile, here are the other stories we're keeping our eyes on. This one from the Philippine Star. The National Grid Corporation of the Philippines is seeking regulatory approval for its 160 billion peso Capex program until 2025. Of the total, NGCP has set over 111 billion pesos for transmission projects. These include completed and ongoing projects, those in the pre-construction stage, and those still in the pipeline. The NGCP has set a capex of 22.3 billion pesos for operations and maintenance and 7.1 billion pesos for system operations projects. The balance is allocated for infrastructure development, IT network, security and aviation, and facilities.
Now, FedEx Corporation's Clark capacity is expected to expand by about 5 times. That's amid plans to use the area as a transshipment base. In a statement, the Trade Department said the transshipment status will mean FedEx will conduct hub and spoke operations in Clark. This means packages arriving in Clark will be reloaded to other aircraft that will proceed to their specific regional destinations. FedEx Vice President Ralph Carter said the company is looking to initiate phase 2 of its project in Clark as soon as possible.
Now, coming right up after the break, BDO and BPI kick off the earnings season with strong first quarter performance.
More of that and other stories when Business World Live returns. Stay with us.
And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Danny Laurel.
And just like that, first quarter earnings season has kicked off with BDO and BPI headlining. Tell us more about our two biggest banks, Dan.
Well, Jess, the good news is both beat estimates for the first quarter. Take a look at your screen here. BDO up by 1.9 pesos already. That's up by 4 6/10%. That's on the back of first quarter net income up by 13% to 11.7 billion pesos. Loans jumping 7% to 2.4 trillion pesos. And also on the side of the NPLs or non-performing loans, that was reduced to 2.72%. So indeed, BDO enjoying some gains there on the back of those strong earnings. Another one enjoying, at least previously enjoying some gains here, but now coming a little bit back down by 15 centavos is BPI. Another one that had beat their estimates here. That's on the back of a 60% jump year on year in first quarter net income. Net interest income up by 12.7% to 19 billion pesos and a 7.1% increase in the loans year on year. Now, they did mention that the profit rose due to higher net interest income, lower loss provisions, and normalized tax expenses. Another one that did increase, corporate loans up 7.7% and even credit cards up by 12.2%, Jess. Now, let's take a look at our index here. I will pull that out for you, and you can see quite a mismatch of how we're doing. The composite down by 0.12%, only 2 in the green, and exactly as you said, your financials jumping by 0.2%, probably led by BDO, but mining and oil down by 0.9%, and the property continuing to suffer there. But that is, of course, on the back of the property space having been one of the worst sold off as well yesterday. And we do have more info on that Fed tightening, and that might be impacting the rate hikes of the Bangko Sentral, which might be impacting the loans there. But we do have one that's very, very optimistic today. That is Vista Land. We see that at 1.92% up in the past 3 days. This, as they have mentioned, or at least Villar is mentioning, that they will begin developing in 44 townships. That's in 23 cities within 1 year. That is, of course, from shifting their strategy from low-cost housing, horizontal, into vertical developments. Jess, they will be spending around 136 billion pesos per hectare. Now, according to Manny Villar, he did mention they've been accumulating these properties for more than 3 decades, and it's now time to be developing those properties. Meanwhile, he did also mention that IPOs are being considered for their other units. They do have power plants, coffee shops, and even other ventures there, even thinking of theme park businesses in the future. So a lot on the table specifically for Vista Land, now trading at 2 pesos and 65 centavos.
Now, POGOs may soon be allowed to pay uniform licensing fees to the government no matter where the economic zone they choose to locate their project. The FIRB said it is now studying the possible streamlining of regulatory fees that investment promotion agencies may slap on POGOs. Finance Secretary and FIRB Chairman Carlos Dominguez tasked the FIRB Secretariat to look into the option of just imposing the same fees across the board. Based on records, there are 32 POGOs licensees and service providers registered with the Cagayan Economic Zone Authority. There are 5 POGO service providers with the Clark Development Corporation, 3 with the Authority of the Freeport Area of Bataan, and 1 with the Subic Bay Metropolitan Authority.
Now on to some corporate news abroad. Warner Brothers Discovery stock tanks after announcing that CNN Plus is shutting down just 1 month after it launched. Let's watch this.
Breaking news. Warner Brothers Discovery is shutting down CNN Plus. That's according to Variety, who cited 2 people familiar with the matter. Taking a look at shares of Warner Brothers Discovery, ticker WBD, shares down close to 8% as we speak. Ritika, we saw shares take a dive lower after Variety made that report. We are seeing additional details now from the Wall Street Journal saying that CNN Plus content is set to move to HBO Max, and that CNN Plus, according to the Wall Street Journal, will shut down on April 30th. We should note that going into this, David Zaslav, who's now the head of the merged Warner Brothers Discovery. He was for years at Discovery before this. He hadn't yet laid out a strategy for what the company was planning to do with all the disparate streaming services. So with the addition of that content to CNN Plus, or to HBO Plus rather, it seems to be that's part of the strategy.
And Tim, I just think this is shocking, though. This is just, what, a month after it launched. It launched at the end of March. I wonder what happens. All that investment that they put into their staff, the producers, the talent there. It's really shocking. And this was actually meant to be one of the most significant developments in the history of CNN.
Warner Brothers Discovery isn't the only one that tumbled. Netflix shares also fell following a massive subscriber loss, and here are the possible reasons for that huge decline.
Netflix had a tough first quarter. It reported the first drop in subscribers in almost a decade. Look at this chart. We can see how the number of subscribers grew and grew and grew, and then in this quarter it dropped by 200,000. They expect it to drop by a further 2 million in the upcoming quarter. Now, why is that? It's partly to do with the end of lockdowns, people not having as much time to spend in front of screens. It's partly to do with inflation, with not as much discretionary spending, therefore people cutting back on their Netflix. It also has something to do with Russia, where Netflix has pulled out of. But it does have implications for the streaming industry as a whole. Look at this chart. It's the price to earnings ratio for Netflix, Disney and Paramount. At the top line, the white one for Netflix, you can see it used to trade at a massive premium to those other companies. Now, Disney, around the end of 2020, pivoted towards the Netflix model. It was going to double down on Disney Plus, focus on being a growth stock. That means investors value it based on how big they think it's going to be at some stage in the future. But if you are a growth stock and growth slows, you get punished by investors. And so you can see here the white line of Netflix crossing below Disney as a valuation multiple. Now, what can Netflix do to reignite growth? It basically has three tools. It can try to add more subscribers. That's clearly a struggle at the moment. It can increase prices, also maybe a little bit difficult given the inflationary context. And the third thing, and that's what it is doing, it is talking about advertising and introducing an advertising funded tier. Now, the advantage of advertising is it might only cost the user a few dollars, but the upside of what you can make from advertisers themselves is almost limitless. If you think about Facebook, which makes something like $130 a year from advertisers per user in the US. That's the growth strategy now for Netflix as it really struggles to add new subs.
And that's a first look into the business day this Friday, April 22, 2022. Join us again Monday next week at exactly 9:30 a.m. You can also catch us on Signal Play. Register for a free account now at www.signalplay.com and stream One News live anytime, anywhere. I'm Jess De Los Santos.
And I'm Danny Laurel. Mask on, wash hands, stay safe, Philippines. Have a great weekend. We are One News.